Welcome to Mad Money. Welcome to Cramer. My friends, I'm just trying to make a little bit of money here. My job is not just to entertain, but to educate, do some teaching. Call me, 1-800-743-CNBC. Tweet me at Jim Cramer. Today, I'm calling it a total mixed bag. Dow dipping 285 points, S&P inching up 0.03%, and the Nasdaq advancing 0.28%. But this week, we put our biggest worries to bed. No more need to be concerned about the president invading Greenland or slapping tariffs on our NATO allies. Which means we can head into next week with a clear head and a focus on the fundamentals. Make no mistake, next week matters. Let's get it started with, I'm calling this cyclical week. You know why? Many of the big industrials and material companies report this week. And it starts with the best steel company in the world, Nucor. Now, with about 2 weeks left in the fourth quarter, as it always does, Nucor pre-announced its earnings results, and those numbers came in well short of Wall Street's expectations. Didn't matter. Stock jumped about 12% since then. And that's what happens when the Fed cuts rates and there are tariffs on foreign steel, as there should be. If the stock gets hit on Monday, you should be a buyer. Tuesday starts with Boeing. Now, this stock's had a monster move since the last quarter. I don't think you can report a number that can equal the actual move, but I wouldn't sell it either because this is the year one of a multi-year turn in the stock of Boeing. General Motors reports too, and CEO Mary Barra never gets the respect she deserves for what she's delivered through the years. Now, the day GM reports, the stock tends to underperform, particularly in the first hour or two of trading, just a pattern that I've noticed, and that's a good buying opportunity. If it happens again, pull the trigger. Hottest group in this market? Well, some would say it's the transports, including the rails. We're going to talk about CSX tonight. I like Union Pacific, which is trying to merge with Norfolk Southern. Let's see what they have to say. We saw Procter & Gamble rally on what a lot of people thought was a pretty bad quarter, okay? Well, Kimberly-Clark reports on Tuesday morning. I think it's going to report a better quarter. Now, it's also merging, though, with Kenvue in a cash and stock deal, and that could keep this stock in its place. But I have to tell you that I'm warming up to Kimberly more and more after what I saw with Procter this week and also with Clorox last night. After the close, we have our first big shortage stock, and that's Seagate. This maker of storage and memory chips has been making a fortune because no one saw the massive surge in demand from the data center coming, except for a handful of companies, including this one. Stock's up over 25% for the year. You need a massive beat and raise for this one to keep it running. And guess what? I think you get it. CNBC Investing Club members, look out! You're going to be flooded with emails Wednesday because terrible trust holdings, Danaher, Starbucks, GE Vernova, Microsoft, Meta, and Corning all report. Let me give you a preview. After a multi-year dry spell, Danaher has big orders from biotechs for expensive management. It seems like a biotech comes public every day, doesn't it? They've managed some better than feared results in recent quarters, but this could be the first truly strong quarter in years. The stock was down barely today. Could be a real interesting opportunity. Starbucks is an oddity. It reports on Wednesday and then has an analyst investor day. Well, it's called an investor day, Thursday. Now, I don't really know how this is going to work. How do you report on one day and then the next day have a big confab about your company? The stock's wildly overbought here, which means it can't keep climbing unless the numbers are insanely strong. I do like it for the long haul, not going anywhere, but I doubt Starbucks can tell a story that's good enough to justify this recent ramp because it's so overbought. GE Vernova's been acting funky. I think that's really a function of the monster moves that it's had for over the years. When it was spun out from GE in April 2024, the stock was at 140. Now it's at 657. GE's old power division has more business than it can handle, courtesy of the data center. Again, I love it long term, but the expectations are sky high for the moment. I think you need a better entry point. We had our Investing Club monthly meeting yesterday, and I spoke positively about Corning, which is busy replacing copper with fiber in data centers all over the country. I don't think I was effusive enough, frankly. I think the prospects are terrific. They own the business. I think you have to just hope it comes down so you can buy some. A bunch of the Mag 7 stocks have been underperforming, at least until today, when they roared. Still, Microsoft, Meta, and non-club company Tesla have turned into stocks that are very difficult to own except for select days. Microsoft's been weak in part because all software companies are under pressure from generative AI. I think that's a false worry in this case, but it's shaved the Microsoft price to earnings multiple pretty mightily. Meta acts terribly until today. It had a nice move yesterday. It was recommended the last 2 days, but I'll tell you what's really going on here. the last conference call when the company reported. Mark Zuckerberg lowered the boom. He said he's going to spend all he can. Can he walk that back, please? Probably not. Maybe he can explain how Meta's at least making money on the data center build-out besides intelligent glasses. Is that too much to ask? I don't think so. Next, repeat after me. Tesla's a robot company. Tesla's an autonomous driving play. It's not just a car company. And this might be the quarter that defines that new narrative. The stock goes higher. If so, here's what's going to happen. The stock is just going to, from the moment you see the results, the stock's going to go sky high. I'm not kidding. That's going to be the one that does the best if they define it as a non-car company. Last quarter, IBM reported a number that left the street rankled, but the stock quickly recovered. I could see it doing the exact same thing this time as traders dominate the stock of IBM. I don't know why, and they don't seem to understand what an amazing company they own or that they rent. Oh, and if you want to know what could be the biggest report of the week, well, at least in terms of consequences, I think it's going to be NOW. I think it's going to be ServiceNow. For years, this company and Salesforce were leaders in software as a service, enterprise software, we call it. Both businesses have continued to do very well, but their stocks aren't playing ball. ServiceNow stock is down more than 100 points from its high. I've never seen that in terms of percentage. The CEO, Bill McDermott, he's got to bring his A game to explain what's happening and tell us that this is merely a broken stock, not a broken company. We are really going to be glued to that one. Now, let's make things really tough. Why don't we throw in a Fed meeting, okay? Which probably shouldn't really be a market mover, but we're getting closer to the conclusion of Fed Chief Powell's tenure, and this could be the day when the president picks his new replacement. I think this meeting's a sideshow, but I may be the only one with that opinion. I'm busy trying to make you money, not trying to speculate on Fed Chief. Thursday morning, we hear from Honeywell. Now, this is really complicated. When the company reports, almost every single time the stock's going down, plain and simple. The stock has run up lately because it's planning to list shares of its quantum business, Quantinuum, and that's got many traders going. They own the majority stake, and it should be red hot. But in the end, Honeywell's still a company that's breaking into three pieces. Well, it breaks into a couple of pieces, and I got to tell you, here's what's going to happen. You're going to get people who say, I don't want the automation. It's going to get people who say, I don't want the aerospace. And the other people are going to say, I don't know how long this thing's going to take, but I don't want to be involved with it. And that's going to cause the stock, I think, to take a hit. Would I sell it Wednesday to buy back Thursday? I'm not a trader, okay? Do I think that's exactly what's going to happen? Yes. We talk a lot about ancillary data center plays, which means Caterpillar, which has backup generators that are needed to keep these server farms running. In the old days, Cat usually went down on earnings. That's over. It tends to rally because people can't believe it can consistently put up such strong numbers. They are wrong. I like the stock. Apple stock's been down for 8 straight weeks. Quite a dry spell. Why is that? I think it's the other side of the storage trade that everybody loves so much. Apple's a customer. It needs storage. They have to pay up for storage, but there's not enough to go around. Prices are way up, and bears say that Apple phones, as popular as they are, will show declining gross margins because of how much they have to pay for these storage components. I'm not changing my view. I say own Apple, don't trade it. But I respect the fact that if Apple guides margins down, it is reasonable to believe that the decline is not over. SanDisk and Western Digital report at the same time. These are our storage plays. They'll be very positive. I don't think they'll get the same reception that Apple does. I think people are going to say, wow, and just keep buying these, even though this one, SanDisk, is up huge, way too much for me. Friday can't come fast enough, all right? What do we got here? We got American Express. Again, I'm going to tell you what happens. They report. It's almost always a good quarter. The stock almost always gets hit. That's been the pattern. You have to buy it right into that weakest. It's stupid selling, I might add, and that's usually a perfect buying opportunity. We also have two oils, Chevron and Exxon. Both throw off a lot of cash. I like Chevron with its big buyback and its 4% yield. It's been my favorite for a very long time because it's so darn consistent. And now you have a possible Venezuela kicker, as they're doing business there right now all through this regime, and they know what needs to be done. The bottom line, Mag 7s, momentum plays, red hot industrials, and a Fed meeting all in front of you. Keep your head up. Much more to come. Let's take questions. Let's go to Jude in Wisconsin. Jude.
Hey, Jim, how are you? Nebius has been getting a lot of attention lately. Where do you see the biggest risks in the company, and how do you see the AI infrastructure build out?
I think that you see these stocks are all overvalued. What's going to happen is one of these Mag 7 companies is going to say, you know what, we're going to slow down the building, and then Nebius is going to be cut in half. I don't want that to happen to you. Let's go to, Dave in Illinois. Dave.
Dr. Cramer, or shall we call you Mr. Pink? Nice work at J.P. Morgan Healthcare Conference. And
thank you.
Shout out to staffers Sean and Josh, the total rock stars.
They are. They're great. They're great. And thank you for saying that because, we all kind of toil in the vineyard here. But you see me and you think, hey, Dave, it's just me out here. What do you need those other people? It's the opposite. Without those other people, nothing happens. So thank you very much.
Absolutely. Jim, this $48 billion company provides healthcare services and products worldwide. Their stock appreciated over 60% last year. Jim, I like them. How about you? Cardinal Health.
Oh, Jason Holler. It's funny, Dave. I'm out there. You got all these great drug companies, and who am I most blown away with? Holler and Cardinal Health and that urology purchase, the new purchase just made. You're dead right. CAH. I can see that stock going to $300. And thank you for the kind words about our team. All right, we've got a busy week coming up, all right? I want to keep your head clear. It's kind of a nightmare, but we'll just work on it together. We'll figure it out. Travel Trust stock Capital One totally blew up last night. I didn't like what happened, but I'm going to say, I'm sticking with it. Then in a questionable economic backdrop, maybe a rail, I don't know.
All aboard!
We'll take a look at CSX and give you my take. And, yesterday we held our monthly meeting for CBC Investing Club members, and we got a lot of questions. Sometimes there are too many questions, so I want to address them here on the show. You got a real preview of what being a member of the club is really like. So here's what you should do. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
All right, what the heck just happened to the stock of Capital One? We own this one for the Travel Trust because I'm a big fan of their merger with Discover, a deal that created a credit card powerhouse. Ever since we bought it for the trust early last year, Capital One's been one of the best performing stocks in our entire portfolio. But over the past couple of weeks, this one's pulled back sharply from its highs. First, Capital One got hit when President Trump started talking about putting a 10% cap on interest rates for credit cards, something that would indeed wreck the entire industry. Because if they can't charge extortionately high rates, then they'll just stop lending to most people. I never worried too much about this, though, because the president would need Congress to make it happen. And more important, it would indeed wreck the economy. Then today, the stock got clobbered for a very different reason. Last night, Capital One reported and also announced a $5 billion acquisition of a fintech company. It's called Brex, B-R-E-X. And the stock plunged almost 8% in response. Sell. At this point, it's down more than 16% from its highs a few weeks ago. And you know what? I think that you are now getting a buying opportunity because it's just down that much. Why? All right, let's take last night's developments, the quarter and the Brex acquisition, and let's do it one at a time. First, yes, Capital One reported mixed quarter. I'm not denying that, with revenue coming in comfortably better than expected, but they earned $3.86. Wall Street wanted $4.11. There were two main drivers of the earnings miss. First, Capital One had larger than expected credit charges in the quarter, due entirely to a $302 million reserve build, which the company said was driven by seasonal loan growth. They explained it pretty well in the conference call. But it could indicate a deterioration of credit quality, so it's not something to be dismissed. And no one did dismiss it. But when you look at Capital One's credit metrics, I didn't see all that much to be worried about. The company's domestic card charge-off rate was down over 100 basis points year over year. That's great. Its auto loan net charge-off were down 50 basis points. That was terrific. Those are not the numbers you'd see if people were defaulting left and right. Second problem. All right. Second problem, Capital One's non-interest expenses came in higher than expected. That's not ideal, especially after the big Discover acquisition. We want to see cost cuts right now. But again, this issue looks like better when you check under the hood. The elevated expenses include a large number of one-time items connected to the merger. I'm not worried about that. Marketing expenses did come in higher than expected too, which I don't love. But some of the other expenses were related to tech investments and other efforts that are worth the money. Not a push. Not great, though. Putting it all together, while the quarter wasn't perfect, the core business is doing very well, and the integration of Discover is proceeding as planned. By the way, Trump's 10% credit card interest rate cap did come up on last night's conference call. There was nothing too revelatory, so we'll just say that CEO Richard Fairbank, the dean, by the way, of the credit card industry, thinks it's a bad idea that will, quote, make credit much less available for consumers up and down the credit spectrum, end quote. I think he made a great argument. I am sure the president was listening. Finally, let's talk about this Brex acquisition, which was the most important development from last night. Capital One described the privately held Brex as, quote, a modern AI-native software platform offering intelligent finance solutions that make it easy for businesses to issue corporate cards, automate expense management, and make secure real-time payments, end quote. Brex also, quote, leverages AI agents to help customers automate complex workflows to reduce manual review and control spend, end quote. In other words, it's a financial technology company that offers modern corporate credit card and expense management solutions. And what you need to know is that this is yet another move from Capital One to, yes, take on American Express. This is basically Capital One trying to expand its corporate card business by offering more value than Amex. Under the terms of the deal, Capital One, it pays out $5.15 billion to acquire Brex. That's going to be half cash, half stock. Brex last raised money at a $12.3 billion valuation. That was back in October 21, the heyday. So I'm tempted to say that Capital One's getting a steal by snapping up the company for less than half that amount. But I think previous valuations say much more about how crazy things got in private markets in 2021. Deal makes sense strategically. I am worn down by it. I'm worn down by Capital One. It was such a great stock. But this is, look, Richard's taking a long-term view, and I wanted the integration of Discover to go smoothly, and now I'm worried about this. I trust Fairbank to be able to integrate Brex while he turns Capital One into a full-service financial company, offering both consumers and businesses everything they might need in banking and credit cards. But I don't think many other people are like me and know his work and are willing to be patient. So if the Brex deal is this good, why on earth did Capital One stock get eviscerated? Well, they missed earnings expectations, even as I'm not as concerned as other people. But really, I think it sold off thanks to high expectations. Capital One had run up dramatically last year, plus some investors are in the stock because they love the Discover deal, and they didn't want to see anything complicated coming out of the quarter today. From their perspective, they'd rather have Capital One just keep using its money to buy back its own stock hand over fist. So they decided to ring the register because it's not what they signed on for. But you know what? I'm still a believer. Capital One is using this unique period where mergers that would normally be blocked are not going to be blocked because of the Trump administration's laissez-faire approach to antitrust. And they're building a very impressive, very formidable challenger in the financial services space, especially in credit cards. After today's slide, Capital One trades at less than 11 times this year's earnings estimates. That's so far below the average large bank. Carried around 21 times for American Express, which is now the closest competitor. Do not get me wrong. I love Amex. I think it's going to deserve a premium. They report next Friday. But even if Capital One closes that valuation gap by half, getting to a point where it sells for 16 times earnings, that would make this a $330 stock. It closed at $217 today. So that's why I'm sticking around in Capital One for the Travel Trust. But it's been a painful couple of days. Here's the bottom line. If you missed this stock's tremendous rally last year, I think it's finally going to come back down to where you can buy it again, probably on Monday. In fact, this afternoon, the Travel Trust upgraded Capital One, taking it from a 2 rating, which means buy on weakness, to a 1 rating, means it's the stock we would buy now. These last few weeks have been tough for the stock, but from my perspective, that just means you're going to be getting a better entry point. And as I'm telling club members, I'm probably going to buy back the stock for the trust that we sold much higher. Yes, the stock is down that much that to me, it's all buy. Mad Money's back after the break.
Coming up, could the new CEO of CSX be the cure for what ails the railroad company? Cramer's rolling through the fourth quarter results to find out. Next.
Last last night we got results from CSX, one of the two major East Coast railroads. And while the quarter looked disappointing, the guidance was strong enough to send the stock up more than 2% today on a down day for the transports. I want to walk you through the quarter, but first let me set the scene. The railroads all sold off incredibly hard last year when the president started ramping up his tariff rhetoric. But once the worst of the Liberation Day tariffs started getting delayed, reduced, or canceled, the entire group came roaring back, including CSX. Oh, then the stock got a boost from merger mania. Last July, Union Pacific decided to acquire one of the two East Coast railroads, either CSX or Norfolk Southern. Because the Trump administration has a pretty laissez-faire approach to antitrust, they figured they could pull it off, creating the first transcontinental railroad, just as Jay Gould sought to do back in the early 1900s. In the end, they went with Norfolk Southern. But that still got Wall Street speculating on whether CSX could merge with someone else, like BNSF, which you may know as the old Burlington Northern, and that's a subsidiary of Berkshire Hathaway. An activist firm called Ancora Holdings even got involved with CSX, pushing for a sale and really berating management for the stock's long-term underperformance. That sent the stock soaring again. But a few days later, it came right back down when BNSF shot down the idea of a merger. They set up a partnership with CSX, but they didn't seem eager to buy it. Now, the activists were also calling for the head of CEO Joe Hinrichs, who, by the way, happened to be the Railroad Man of the Year right when they were doing this, and he ultimately got ousted last September. I think this guy got a real raw deal. He had to deal with Job-like series of rolling issues, including the supply chain crisis, raging inflation, Fed rate hikes that crushed cyclical customers, a freight recession, and then the Baltimore Bridge collapse, Hurricane Helene, multiple port strikes, some tricky labor disputes, and most recently, tariffs, and a big snowstorm. Oh, no, that's something else. That's going to happen Sunday. Have it in my head like everybody else. Sure, CSX had underperformed the S&P 500 from 2022 when he took over to last August when Ancora started trying to push him out. But that's true of all the railroads. In fact, during that period, CSX had the second best total return of any publicly traded Class 1 railroads, behind only Norfolk Southern. Norfolk Southern only won because it got a takeover bid. Still, there was a silver lining here. When CSX got rid of Hendricks, they brought in this guy that we really like, a terrific replacement. His name is Steve Angel. Now, he was formerly the CEO of Praxair, who sold his company to Linde, the industrial gas giant, in 2018. Then he ran Linde until March of 2022. Now, get this. Under his leadership, Praxair gave you a total return of 257%. Linde gave you a 219% return. We had that for the Travel Trust. Thank you, Steve. Well, we've had him on the show a bunch of times. He's a fabulous industrial. He's a great operator. But, not a railroad guy, but a great operator. The big question here is whether Angel was brought in to put CSX up for sale, like he did with Praxair, or if the board simply wants him to build a better company. His predecessor only got fired because he failed to sell the company to Union Pacific. When CSX reported in October, Angel was asked that question point blank, and he said he's open to strategic opportunities. But he also pointed out that he ran Praxair for a decade before he sold it to Linde. His philosophy is that you should run the company to do the best of your ability. So if there's a merger opportunity down the road, you're coming into it from a position of strength. Common sense. Still, Steve Angel is 70 years old. And while I happen to think that is like the best age in history to run a company, I don't think he was brought in to run CSX for a decade before selling it. After all, they've really only got 3 years left to merge with another major railroad. I don't see any other White House possibly letting that kind of deal through because this industry already has a high level of concentration. Plus, even the Union Pacific Norfolk Southern deal has run into some speed bumps, as you expect, with pushbacks from the union, a couple of competitors. Just last week, the Surface Transportation Board, the first organization that reviews these things, ruled that their merger application was incomplete. While it probably won't be difficult for them to fix that, the fact is that even the merger-friendly Trump administration is going to rubber stamp this. Then again, the most logical acquirer here, and this is what I think if you own the stock you should hope for, is Berkshire Hathaway's BNSF. That deal was shot down by Warren Buffett last year, but now Buffett is retired. And his successor, Greg Abel, is making some changes. He seems ready to dump Kraft Heinz. It's a chronically underperforming position that Buffett was very attached to. So maybe he's willing to consider buying CSX. I got to tell you, though, while I like CSX, I sure wouldn't buy it purely for takeover speculation. I buy it because I think the business is set to improve dramatically this year, and a lot of the big problems are behind them. Which brings me to the quarter CSX reported last night. This was Steve Angel's first real chance to unveil his plans for the company. What did we learn? First, the headline numbers were not good. A modest top and bottom line miss. That's mainly because the broader rail freight market is not that good right now. See, on the other hand, CSX reported very good operating metrics. That's things like train velocity, dwell time, trip plan compliance, safety stats. CSX also managed a 1% year-over-year increase in volumes despite the weakness in the industry. But the rails don't have much pricing power these days, which is why the sales and earnings disappointed. Of course, you wouldn't realize that if you looked at the at CSX's stock today, which rallied nicely. I mean, terrifically. Mostly that's because management gave us a pretty darn good full-year forecast, calling for low single-digit revenue growth and 200 to 300 basis points of operating margin expansion versus last year. That would be unbelievable if Steve could pull that off. How do they plan to make it happen? Okay, CSX is coming off a year of very elevated expenses. The company completed 2 major capital projects in 2025, expanding a tunnel in Maryland, well, that took forever, and rebuilding a line in North Carolina and Tennessee that was damaged by Hurricane Helene. These were big. That's a major reason why they shelled out $2.9 billion in capital expenditures last year. Simply finishing these projects will result in major savings. Management's guiding for $2.4 billion in capital expenditures for 2026. Free cash flow growth of 50%. Could be a lot of money to buy back stock. Overall, CSX is also aiming to cut costs aggressively this year, although I would argue that they've been doing that every year. Importantly, Steve said explicitly, and I'm going to quote, he says, CSX, quote, does not anticipate any meaningful improvement in macroeconomic conditions, end quote. His call for low single-digit revenue growth is based on flat industrial production and modest GDP growth. In other words, if the economy actually improves a little bit, that's pure upside for CSX. It's absolutely not in the numbers. We've had a long-standing freight recession in this country, and I think there's a chance the industry starts to bounce back this year, although we clearly aren't there yet. With a freight recovery, these guys could print money. You would want to own it really badly. Put it all together. You know what? I think CSX represents an excellent buying opportunity, even after today's 2.4% run. This is a company that's going to do a lot of self-help, and the numbers should improve dramatically just because they plan to spend a lot less than they did last year. But the bottom line, while the CSX should do fine, even in a fairly stagnant economy, I think it is going to be a big winner if the economy actually picks up steam. And a humongous winner if they somehow manage to attract a takeover bid. Again, don't buy CSX for that takeover speculation alone, because the fundamentals are improving, and there's an outside chance that another railroad might want to merge with them. CSX, I like Joe, I like Steve, I think it's going to work. Let's go to Leslie in California. Leslie.
Jim, I'm back. Jim, I'm wondering what your weekend plans are. Given the
my plans,
bad
let's see. Well, my wife had a knee replaced, so I think I'll hold her hand because she's in a huge amount of pain. I'll do that, and then I'll move into a hotel that's nearby this place because everyone's so worried about the storm. And then I'll put I'll take the under on 21 inches on Kalshi. Okay.
Dover Corp, buy, sell, or hold.
Oh, well, now you cut me to the quick with that one. All right. Dover reports next week. It's too close for me to determine. I said yesterday at our meeting that I liked Dover, but it had jumped 5 points the day before, and we took a little off the table. It went down today. At this point, we have to wait till the 29th for the quarter before we opine on it. I do think that Rich Tobin is doing a terrific job, but we don't have enough info. Let's wait for the quarter. And thank you. And thank you for asking me for my weekend plans. No one here cared at all what I'm doing. They're all talking, and they never asked me. What's that about? Let's go to Greg in New Jersey. Greg.
Hey, Jimmy, thank you so much for what you do for the investment club, and the book has been fantastic.
Oh, I'm telling you how to make money in any market. I saw some people yesterday reading it. I was very excited. I'm still doing well. I'm thrilled that you mentioned it. How can I help?
Hey, listen, AI is all about the power play, and GE Vernova has been like the centerpiece for everything, and I will never sell that probably for a while. But the question for you is Oklo has been getting a lot of print, a lot of momentum, and buy, hold, or sell on Oklo.
Okay, Oklo, I've been saying sell it. It's been knocked down pretty bad. I think there's always these yahoos who want to come in, it's up 22% for the year, who say, well, listen, it's going to be the next greatest thing ever, and their technology is unbelievable. This is nuclear power. And when we talk about nuclear power, you're right. GE Vernova knows how to build a plant. Everybody else is just trying to learn and is not commercial. OKLO is not a commercial enterprise. Period. Thank you for the comments. Very kind of you. I wouldn't buy CSX on takeover speculation. I buy it because the fundamentals are actually improving. They got a new CEO, Steve Angel, that I really like. Much more Mad Money ahead, including some very smart questions from members of the CNBC Investing Club. Then most of the winning names in this tape have one thing in common. I'll reveal it. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Been a dramatic short week for the markets. Do you believe on Tuesday the S&P actually turned negative year to date? So we thought we ought to step back and address some of your concerns by taking some questions from our Investing Club members. Yesterday we held our Investing Club monthly meeting. These are pretty intensive things, believe me. And Jeff Marks and I get together, walk club members through our decision-making process for the portfolio, discuss our current holdings, and then we take questions from club members. We always have a few left over, so I want to show you what you get from this part of the club meeting. Consider an inside look at what happens in the meeting, so I want you to join the club. I also want to give you some much-needed advice here. So if you like it, go scan this QR code and join the club, please. And I thank you very much. First up, we have a question from James, who asks, Jim, the swings in the market happen in a matter of minutes or hours. With all the computer-driven programs, how does an individual stay in the game? Okay, here's what you do. You use what I call limit orders, okay, not market. You figure out what you want to pay for a stock. You use that price. You don't give anybody else the price. You don't let the market take control of it. You decide what you think what the company's worth, and then you play it your way. Don't let the market determine what you want. Decide how much you'll pay and nothing more. Next, we have a question from Robert in Florida who asks, I purchased Netflix after the stock split, and I've been in a world of hurting. Jim, do you think in 2026 Netflix will get back on track, or should I take a loss and sell it? I have to tell you, Jim, I thought that the conference call this week was a show of force. It was so good. It made me think that Netflix completely is on its game. As always, you should be a buyer of Netflix here. Next up, Michelle in Colorado asks, do you have any thoughts on what type of business would benefit from AI advancements beyond the producers of chips, energy, and infrastructure? I'm thinking of businesses that implement the technology to enhance their efficiency. That's going to be the banks. The banks don't talk much about it. The one that I think has the best handle on it is Wells Fargo. It's a big reason why we own it for our charitable trust. WFC is the stock for you. Next, we have a question from Joseph who asks, when is it best to reinvest dividends versus banking them for other opportunities? It's never good to bank for other opportunities. We always reinvest. It has to be a very particular kind of situation we don't reinvest. Typically something that you're stuck in and you don't want to have more of, which is a very rare thing. I'd like you to sell it. Some people can't sell stock because it's restricted. I'm in that situation and don't need to talk about it much beyond the fact that I would love to be able to sell and I can't. But otherwise, reinvest. Next, Harry in my home state of New Jersey says, Jim, could you expand more on income generating strategies that prioritize capital preservation, particularly for older investors who are focused on living off a portfolio income? Because of you, I wrote a particular chapter on how to make money in any market. It is for you. It's a list of stocks that I would buy right now if I were allowed to own stocks. Not for the trust. These are not charitable trust names. These are ones that I would use for income. They're all there for you, and they're vetted by me, and I spent about a year being sure that they're good. So let's go take a look at those. Next up, Gary asks, what's happening with AutoZone stock lately? It has been a darling stock for years. As of the last 6 months, there's been a breakdown in price from a one steady up and right chart. It's just a buy, sell, or hold. All right. This one mystifies me. I have been a believer in this stock for some time. They have the best buyback. Take a look. They've shrunk the float by 50% just in the last few years. There's nothing. At first, I thought it was tariff parts. That could be a problem, tariff parts. But at this point, I just don't see a lot of downside. Yeah, I mean, we just had this nice pickup, but I think this is where you can get back in. It has been mystery because I've been recommending the stock for more than 10 years. Next up, we have a question from David, who says, small cap stocks seem to be all the rage lately. What do you think about them? There's too much, including our network, people who just say, oh, the Russell 2000, but don't know the individual stocks. As I look at the individual stocks, I see very little that I really like. Why? Because I like balance sheets. I like earnings. I like scale. I like companies that have a moat around them. Almost every one of those companies that I check every time I look, don't. People buy the Russell. They buy the index. I'm stuck with buying individual companies. And you know why I do that? Because you outperform when you do it my way. Next, we have a question from Richard who asks, based on the belief that chip and related stocks are cyclical, how do you know when to trim or get out? They are not cyclical. There are particular ones. NXPI is cyclical. On Semi is cyclical. Texas Instruments is cyclical. Most of the others are not cyclical. Most of them are secular. Those big three are the three that I would say you can't possibly buy because you have to buy them and then sell them, and I don't like that. Next up, Bob asks, I was wondering if you have considered investing in any of the defense contractors. It would seem that they offer a reasonable dividend and be a good investment in the long run. You're right. I liked AV, which is Aero Environment. I like Lockheed Martin. I've always been confused about whether to get into what I regard as the hornet's nest of the president saying that they can't buy back stock or they can't pay dividends. Too hard for me. But those are the two that I think still work. AV, I've liked since 78. Lockheed Martin, I've liked since James Takeley came there from American Tower. Next, we have a question from Chris in North Carolina, who asks, what do you think of Caterpillar? It seems to be richly valued at its current price. How much would this stock have to fall to start a position? The stock was down really horrendous today. I didn't understand it. Reports next week. There are a lot of people who feel that this is a data center play and that the data centers are somehow going to stall out. You are coming in after a major move. I would like to see the stock lower. Once you start getting lower, what happens is people say, uh-oh, it's going to be topped. It's a head and shoulders, all that. I liked when Jim Umpleby was CEO. He did a fantastic job. I believe it's worth a great deal, but I do prefer right here Cummins, CMI. I think it represents a better buy. All right, finally, we have a message from Jerry, who says, longtime member, thank you for what you do. You have really changed our life. If Jesse James knew of Jim Cramer, he would have never robbed banks. Well, that's quite a nice thing. I pride myself in the club. Last night I had some dark thoughts about my wife didn't like the way the call came out. She thought I was too somber. And I said, no, wait a second. We've changed people's lives. That's all I've ever wanted to do on earth is change people's lives for the better. I have received a huge amount of criticism in my life. And you know what? I don't care. Thanks again to all our club members. Ben Mike's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the light round. I shall search under the course of it. I'm a step first where you play this out. And then the lightning round is over. Are you ready, Ski Dad? Tell the lightning round. Let's start with Chuck in Florida. Chuck.
Hey, Jim, calling from Valencia Sound in Boynton Beach. How are you?
Oh, fantastic. How are you, Chuck? Good to have you on the show.
Thanks. I just wanted to ask you, Jim, before I ask you about my stock, a quick question. Why do analysts raise their price targets to an amount that has already been surpassed?
That's usually because they've been left behind by the stock and didn't foresee the big move ahead. It's always very embarrassing to me, frankly. They should just frankly admit that they missed it, but they never do. How can I help you on a stock? What's up?
All right. I wanted to ask you, Jim, about a digital bank. They operate in Latin America, mainly in Brazil, Mexico, and Colombia. They received approval, I believe, for a U.S. bank charter. And they also received multiple upgrades from Goldman Sachs, Morgan Stanley, Bank of America. The stock, Jim, is New Holdings, symbol.
I think, look, I like New from when it came public. I think it's okay. It's a little, to me, I don't know. I don't like a bank that has that big a price earnings multiple, even if they are a very forward-looking bank. And by the way, if you want an international bank, let's not forget, it's Santander. Let's go to Scott in Minnesota. Scott.
Mr. Cramer, as the club member, and I want to thank you for helping me and all my grandchildren.
Yes, thank you. Thank you.
What are your thoughts on buying more ARM holdings?
Okay, ARM's very interesting here because they did see the big shortage coming. Renee Haas got it right. I think you do buy the stock, and I think it's a great call, and I want to thank you for those kind words. Let's go to Doris in Indiana. Doris.
Hey, Jim Cramer, thank you so much for everything that you do.
Oh, thank you.
I may have overbought Celestica, and I'm a little concerned about what I'm hearing about Google maybe backing out of it.
Yeah, I saw that too and was thinking, boy, Celestica's really too high if that happens. Why don't you trim some on Monday? I don't know what's going to happen, but the stock has been a big run. You'll certainly feel better about it if you take that action. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, looking to capitalize on the current shortage in the memory semiconductor market? Cramer's pointing you to the gold standard for success right now. Next.
This market's being driven by shortages. If your product's in short supply, your stock goes higher. It's knee-jerk. You may disagree with it, but Wall Street doesn't care about your opinion. We've witnessed endless buying in the memory and storage stocks in the last year. Think Micron, Seagate, Western Digital, and SanDisk. That strength is extended to the semiconductor capital equipment makers like Applied Materials, Lam Research, and KLA. These groups got hit today off the pin action from Intel's disappointment, but I think that's mistaken pin action, and I'll explain that in a moment. We have a huge aircraft shortage. That's behind the resurgence in Boeing. The travel boom has fed endless plane orders to Boeing because it's one of the only two companies that can make huge commercial aircraft in scale. There's a reason Boeing stock just took out the level where it was trading before the Alaska Airlines accident 2 years ago. Aircraft shortage by Boeing. All that said, if your stock's been rallying as a shortage play, this market will turn against you in a heartbeat if you somehow manage to drop the ball. Last night, Intel reported a decent enough quarter, but offered distinctly suboptimal guidance for the current quarter, which it said was totally because of the CPU shortage. Remember, anything that goes into a PC or a server is in short supply thanks to the data center boom. So Intel can't make enough CPUs to truly profit from the shortage. They planned wrong. They were caught unawares. It happens, but that's why the stock got obliterated today, down 17%. They didn't factor in the storage correctly. There was just too much shortage, just way more than they thought. Of course, that's great news for the main competitor, AMD, which rallied nicely today because they did factor in the shortage. We wish we had not sold AMD for the Chapel Trust, but that's woulda, shoulda, coulda. Intel's slide was so bad that it dragged down the memory chip makers. Pure guilt by association, but that's ridiculous. Intel doesn't have a problem with demand. They simply can't produce enough supply. The industry's in great shape. This is just one company with lackluster execution. And no more than that. I think Intel's still a great company. It's come back under Lip-Bu Tan. I think it's going to take advantage of the CPU shortage. And I do believe that Lip-Bu can fix what's ailing the company. It was a very broken company when he came in. Now, last night I told you that the Intel breakage would reverse the huge flow of money out of the Magnificent Seven into the shortage plays. And to some extent, that happened. The money flowed out of the shortage plays right into Mag 7. We got some lift in Meta and Microsoft responding to positive research notes. Amazon rallied on the news. They planned some big layoffs. NVIDIA eventually rallied. And rumor the Chinese government will allow them to sell their H200 chips to ByteDance, Tencent, and Alibaba, although it took a while for that stock to gain traction, and I'm still not sure that story's true. These are all jumping because the money flew back from storage into Mag 7. It just goes back and forth and back and forth, and it doesn't impact them all. Apple saw its stock fall for the 8th week in a row because anyone who makes phones or computers is a victim of the memory shortage. They have to buy a lot of these sky-high shortage devices. People say sell Apple off it. I'm not a believer, but I recognize that's what's happening. Of course, it's not just tech. We've got some real shortages in metals. Gold, silver, and copper are climbing relentlessly. The world has a lot of copper, so even though it's used in the data center, I'd be circumspect about chasing it. But man, silver's up 46% since the beginning of the year, and gold's up 15%. Now, a lot of that's because the dollar's weak. It's a storehold of value, but we do have a permanent shortage in gold, not in silver, but in gold. Each year, we only replace about 1% of the world's holdings between all the geopolitical uncertainty and the weakness of the dollar. There's huge demand here. I would buy Agnico Eagle if I wanted to participate in it because they're the best miner. The CEOs of the best gold companies have always told me that one day we'd all learn that crypto simply doesn't hold its value as an inflation hedge. Only gold could. I like crypto, but I think that the gold miners are turning out to be perhaps right. Crypto turns out to not be a great inflation hedge. The moves we've seen in the last year show you that crypto seems to lack something that gold and silver have, and I think it's the shortage factor. There's just not enough being made. My advice, own gold, don't trade it. I like to say there's always a bull market somewhere. I'm trying to find it just for you right here on Mad Money. I'm Jim Cramer. See you Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC or its parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.